Hello, I'd like to talk today about tax returns and let's simulate some tax returns with some Roth conversions and without Roth conversions, and then we're going to throw in some capital gains taxes. Let's say we wanted to harvest some gains on our taxes and we have over 1 year investments that will return capital gains. So we're going to simulate for both single and married. So here we go. I'm going to start off by going to dinkytown.net. Okay, and here we are at dinkytown.net. And this software here allows us, it's a website that allows us to do our retirement savings, auto calculators, loans. So pretty useful site, and highly recommend using this. So we're going to go to the tax calculations today, and then we're going to go to the 1040 tax calculator here. Very end, we're going to see how the tax implications affect when we're doing Roth conversions and when we are doing capital gains conversions. I want to show sometimes if you have long-term capital gains, it is very important to put this in here, and then we'll get an accurate information as far as how much it will affect our taxes. So let's go. So 50-year-old single and 50K capital gains. So here we go. So we are filing status, so single, no one, he has no kids, okay? And then wages and salaries, we get 50K in here, okay? And then we're going to go all other income sources. Let's say he had some capital gains, okay, 50K. So long-term capital gains, and the importance of knowing what a long-term capital gain and short-term are. Well, long-term is over, your funds are invested for over a year, okay? So let's go to there. Let's click on this little question mark here, and then we can read that this is total property realized from the sale of an asset, stock, bond, real estate owned for more than 1 year. Okay, all right, very important. All right, so we're going to say there's no other gains or losses, and we will go down here and we will say that he has a standard deduction. Okay, which is for a single person is 14,600. Okay, so we'll leave all of these alone. He didn't give a whole bunch of money or anything like that, and he has no other deductions. So we'll go with the standard one, which is pretty good. So it tells us our taxable income is 100,000 because you get 50 from his salary and then 50 from the capital gains tax gains. And so his total amount minus the 14.6 is 85,400. Okay. So now we're going to go down to your estimated taxes are at $9,775.25. So what this means is usually your employer will start to remove some, of your taxes, and so this is how much he will be required to pay that year. Hopefully, he, has his employer take out that much. But we can see inside of here that $100,000 total income we have, then we have total taxable income is the 85,400, and then total income tax is the 9,775. So things to notice here: if we did $50,000 in long-term capital gains, we go down here, we can see should be some information as far as capital gains, long-term capital gains rates, and this is a single. So this person here, he actually has he fell into this bracket right here, which is a single. He's single, and he's going to be paying 15% on anything above that. So let's do a small example, and let's go put in this exact number right here, 47,025, and we were going to see how much additional tax he pays. So it's the difference of 50,000 to that number that I just gave you. So let's remember this number here, the 9,775, and then we will put in up here this number right here, 47,025. We will recalculate it, okay? And as we see, it was 97725. Now it's actually 9329. Let's see what happens if we even lower this a little bit more, because it should not change how much he is taxed. So we just changed it to $45,000. And as it did change it just a little bit. So he was paying slight amount of tax on there. But we can see that our total amount here is $9,025, which was reduced. One thing to note is here are this is a 9.5% of your total income and $95,000. So the total tax payments a year were $0. All right, let's go with scenario 2. Scenario 2 is we have a single person, 50 years old, and he does 50,000 in Roth conversions and 50,000 capital gains taxes. So let's go there. So we'll about push this up to 50K. So that's capital gains. And now we have, he's going to do some Roth conversions. So let's go to where that is. So it's additional income. Where's that? Oh, there we go. Total taxable IRA distributions. So this is enter any IRA distribution as taxable. This would normally include distributions from a traditional IRA, simplified employee pension, IRA, a simple IRA, and this also includes conversions of any of these IRA accounts to a Roth IRA. Okay, so that's where I got that. Close this, and I'll put 50K in here. Okay, and now let's recalculate. Let's go down and see how much this changed our value. So now we just, because of that, we just jumped up to the 22% tax bracket. That's quite a bit extra there, and it's because he's single. It really affects him. You know, if he was married, he would not be paying as much. So let's take a look at his total tax bill here. What's that rest? The calculation. Okay, this shows right here. I minimized. All right, so in this scenario, he made $150,000 total income. Total taxable is $135,400, and then his total income tax is $21,347. So in this case, I would probably tell this guy to not do the Roth conversions right now because he's at a truly he's not too high, but 22% is higher than 12. You know, so I would say you'd probably want to be in that 12% bracket. So if he has a lower income year, or let's say he didn't claim his capital gains this year, that would be probably a wise choice. So let's get rid of his capital gains, and let's just go with that Roth conversion of 50K. So, okay, let's see what happens there. So it goes almost back to where it was. So we got 13,847. I think that's a little higher than it was before. So that is the single person. Okay. So now we're going to go with the married person, and he's got 50K in capital gains. So married and 50K. So married finally jointly, no kids, 50K. All right, and then we will put in 50 capital gains. So we're going to remove this guy for now, and we're going to add long-term capital gains. Okay, and the thing about this one is he now falls. I'll put 0 there. Okay, so calculate. So now this married couple here, they're making 50K. They have 50K in capital gains, and let's take a look at this. So he is going to pay only 2%. Okay, so the total income was 100K. Total payments, total taxable income was 70,800, and then total income tax on that money was $2,083. So it puts him into the 10% tax bracket, but he didn't make a lot of money, so it reduced his taxable bill to $2,082.50, which I think is pretty awesome. So let's see how this compares with a married couple, and they actually put some money into their Roth account. Here we go, 50K in the Roth account. Okay, and we'll go down here, and all right, so when you put money into your Roth account, you're automatically going to be paying tax on it, but it all depends on how much did you make that year? Did you make a lot of money? You know, did you make let's say you made $50,000 like this person, and then you add on that $50,000 conversion, Now you added that, and then you have a capital gains tax, which capital gains tax you can prevent that. You don't have to claim the capital gains every single year. You can postpone that, But if you have a good year, it might be wise to do. Talk to your tax consultant. Of course, this is just information purpose only. Anyway, keep going with this. So this is a 8.03 of your total income. So you had $150,000 total income. Your total tax payments a year were zero, and your outstanding tax bill is estimated at $12,047.50, and this puts you in a 12% tax bracket. So, what this is showing you is that you fell into a bracket of capital gains tax bracket. So let's go down here and see where that capital gains tax bracket is. Let's find out. There it is, long-term capital gains. Okay, and then this is married filing separate. I'm sorry, not married filing jointly. Okay, and you, as long as your income is below 94,050, you fall into this 0% capital gains. So let's change this capital gains up here. We're gonna see what happens when we change our capital gains. Let's say we made a lot of money this year, and we want to put this up. Let's put up to $90,000 and see what happens. So it increases our total income, of course. We calculate, okay, so now we're paying 9.5% of total income of $190,000. And your tax payments this year were zero. You still fell within that capital capital gains tax bracket, and your outstanding tax bill is 18,047. So what happened with this one is this increased quite a bit because we realized a lot more gains. So we're filling up these like buckets here, and the buckets filled up too much, and now we got to pay quite a bit of taxes on that. So in this year, in this scenario, I would say this guy here, he drops this number down because I don't think we want to be paying $18,000 taxes. Okay, it probably would not be wise. So maybe reduce this amount unless you really, really had to. But let's change this down to 50K, and we'll go back to that number. So that was 18,000, and now it's only 12,000. So it's just taxing you on the Roth right now, which is great. I mean, uh, so yeah, we're in the 12% tax bracket. We if in this year, let's say we didn't do any Roth conversions, we only had that capital gains tax. So let's put a zero here. Let's see what happens here. So now we only pay 2,083 at the end. And let's put more money into our capital gains now. Let's roll back up here. Let's put in our 90,000 in our capital gains. See what happens there. Okay, calculate. Let's go back down and 4,500. So we're still paying a little bit more, not much. We're only paying 3.28% of $140,000. So I think that's pretty darn good. But yeah, if you play around your brackets and you keep this down, so let's say you wanted to keep this ultra low, you could do a lot lower capital gains. So let's say 60K. What happens at 60K? We're still, look at this, we're still at that 2083. So there is a threshold at which we will start raising this number. So let's put in 65. What happens here? Okay, and then still the same, 70. So we see that we're hitting some sort of threshold when we're doing this. And now, still the same, awesome. All right, 75, let's go to 75. So my guess is it's our total W-2 income minus our standard deductions, which have been changed, raised. All right, so we found the threshold limit there. We raised up just a tiny bit, but still, that's really, really good. So $125,000 total income because of all those conversions, and only a tax rate of 1.88%, which is fantastic. I mean, this is the way that you can legally put your money into other vehicles of sorts, and they you're not taxed on it as much, and we can actually save quite a bit by doing this. So hopefully, talking with your financial counselor or CPA, they can help you figure this stuff out. But this is just information that I want to provide to everyone and allow them to make their own decisions and choices here. So now we know how much we're going to pay with our federal taxes. Let's figure out what's going to happen with our state. So let's go with that one. That is. But here is okay. Whenever you have all those taxes and you made that $2,000 right here. Okay. Okay. You have to pay total income tax $2,345. Well, depending on the state that you're in, you have to pay additional state tax on that. So you will have to pay 4% on that in Michigan, 9.85 in Minnesota, and then some of these states are actually Arizona. I noticed was nothing, zero. So yeah, it's a Wyoming, zero income tax or capital gains, and so yeah. Let's see where else. Some of these have, yeah. So depending on your state, it's going to vary how much capital gains. So Texas, no capital gains. Tennessee, no capital gains. South Dakota, no capital gains. So yeah, if you want to be saving a couple bucks, off of your total tax liabilities, then yeah, your state can make a difference.